Welcome to Woods of Stardon. This is CH. I will be covering the FTIF Templeton Global Total Return Fund in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the JP Morgan Global Income Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. The company started off as Franklin Distributors Incorporated, a US investment firm focusing on providing mutual fund solutions. It was founded in 1947 by Rupert Johnson, who named his company after Benjamin Franklin, one of the founding fathers of the United States. In 1992, Franklin acquired Templeton, Galbraith and Hansberger Limited. The latter was owned by Sir John Templeton, who, among other accomplishments, is famous in the funds industry as a pioneer in emerging markets investing. The resulting company is rebranded as Franklin Templeton, as it is known today, with Benjamin Franklin's portrait as part of its company logo. Today, Franklin Templeton is a multinational investment management holding company. In the US, its business branding is Franklin Resources. Elsewhere, besides its own Franklin Templeton branded products, it holds a long list of boutique fund management brands that it has acquired over the years. This has led to Franklin Templeton becoming one of the top global fund providers today, managing about $1.68 trillion of assets via 1,500 investment professionals located globally. While Franklin Templeton publicly listed its US business Franklin Resources in 1971, the company has through the years retained control and leadership within the Johnson family. Rupert's son, Charlie, took over as president and CEO in 1957. Charlie passed the baton to his son Greg in 2005, who became the CEO. In 2020, Greg's younger sister, Jenny, took over as president and CEO. The Templeton Global Total Return Fund is a sub-fund under the Franklin Templeton Investment Funds or FTIF fund family. FTIF is set up as a Luxembourg SICAV structure and is UCITS compliant. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The lead manager of the Templeton Global Total Return Fund is Michael Hazenstep, who created and incepted the fund in 2003. He is supported by co-manager Kelvin Ho, who joined in managing the fund from 2019 onwards, replacing Sonal Desai, who transited internally to manage other Franklin Templeton products. Michael is the Chief Investment Officer for Templeton Global Macro, a team that focuses on in-depth global macroeconomic analysis to provide global unconstrained investment strategies. He is also a member of Franklin Resources Executive Committee. Michael is best known for the three main mutual fund offerings he launched that embedded similar investment philosophies and strategies. The Templeton Global Total Return Fund that is covered in this video has the broadest universe, encompassing global corporate and government bonds. The Templeton Global Bond Fund is also global, but focuses only on local and hard currency government bonds. The Templeton Emerging Markets Bond Fund, on the other hand, focuses on emerging markets, but for both corporate and government bonds. Kelvin has been working closely with Michael in the same team since 2005 as a lead research analyst specializing in global macroeconomic analysis and exchange rate modeling. He now co-manages most of the funds Michael is responsible for. The Templeton Global Total Return Fund seeks to maximize total return that includes both income and growth of capital. This is essentially a global unconstrained bond fund that invests in both corporate and government bonds, and as per the investment objective, has no currency or credit rating constraints. This is quite broad and generic, so let's see if the fund prospectus provides more details. The prospectus elaborates further on the scope of the investment. The fund can invest in both fixed and floating rate bonds from both corporate and government issuers. That includes supranational entities as well. The fund can also invest in non-conventional bonds, such as securitized assets like MBS, and also CDOs and CLOs, and also all sorts of derivatives to help adjust and even provide negative exposures in specific yield curve or duration, currency, or credit. Specific investment constraints include maximum 30% in China onshore bonds and maximum 10% in defaulted bonds. The prospectus then provides some examples of derivatives usage, such as using US Treasury futures to manage interest rate risk, or using index-based derivatives and credit default swaps to get indirect market exposures. There are also a bit more investment constraints mentioned, including max 25% in a non-investment grade sovereign issuer, and also max 100% in money market equivalent instruments. The latter means that the fund does not have to stay invested and can temporarily exit all bond market exposures in event of a market crisis. There is also a mention of total return swaps and securities lending transactions, although they are expected to be small at around 5% each. This is a fund that actively uses leverage, with an expected level of 200%. Leveraging can be a double-edged sword, so it is highly important for the fund to have a strong risk management process to reduce downside risk due to leveraging. While the fund is unconstrained and doesn't have an objective to outperform a benchmark, it still has defined a blended benchmark for reference purposes. From this blended benchmark, we can get a feel of how the fund portfolio may be constructed. The benchmark has 25% specifically in Global High Yield Index and 25% specifically in emerging market government bonds, with half in hard currency sovereigns through JPM EMBIG Index and half in local currency government bonds through JP Morgan GBI EM Index. The remaining 50% is in the broad Bloomberg Multiverse Index that comprises mainly developed markets, sovereigns, and corporates. This benchmark suggests that the fund has a decently high emphasis on high-yield bonds and emerging market government bonds. Last but not least, the prospectus states that the fund has a US dollar-based currency. However, having gone through the investment policy descriptions, currency play appears to be one of the returns attributions, so the fund portfolio is expected to have plenty of non-US dollar exposures. The prospectus unfortunately does not provide information on the investment philosophy or investment process of the fund. As a typical retail investor, we can get a glimpse of this in the periodic articles published by the fund managers as shown here. Using the February 2026 Global Macro Insights article as an example, it starts with a detailed assessment of the general market and economic overview, suggesting the team and the fund adopts primarily a top-down investment approach, focusing on making the macroeconomic assessments first that leads to portfolio adjustments. The article then provides an elaboration of the positioning adjustments with rationales. From here, investors can get a better understanding on how and why the portfolio geographic and currency exposures are adjusted, among other things. Specific bond investments are seldom mentioned unless it is to stress on certain government bonds or specific maturities to highlight the duration views of the team. So the bond selection process and criteria are unfortunately not available to investors. The Templeton Global Total Return Fund was incepted in 2003, giving it more than 20 years of track record. The fund currently has about $1.75 billion worth of assets, which is a decent size, although it used to be much bigger. The fund webpage provides a detailed geographic breakdown of the portfolio sorted by regions. From here, we can already see that this fund is significantly different from most other typical global bond funds in the market that are mainly exposed to US and Europe. This fund, on the other hand, has only 12% US and 5% Europe, with the rest scattered across emerging market countries in Latin America, Asia, and Africa. Besides US, the top country exposures are India, Brazil, and Egypt, with about 9% each. Purely looking at this, I would probably consider this more as an emerging markets bond fund instead. Currency breakdown tells a similar story, with actually slightly negative notional exposure to US dollars, and instead having currency exposures scattered across emerging markets. This shows that the fund is currently mostly a local currency emerging market bond portfolio. Credit rating breakdown is found in the fund fact sheet, where we can see the fund has about 39% high yield rated exposures. While the average portfolio credit quality is maintained at BBB, the amount of high yield exposures in the portfolio should again highlight to investors that this is not a typical low risk global bond fund. Average maturity is at 5.9 years and effective duration is 4.24 years. Though without any investment constraints, this may change significantly depending on the changes in the macroeconomic views of the fund managers. Morningstar provides the bond segment breakdown, and it is surprising to see the fund currently has only government bond exposures with completely no corporate bonds. There is also a lot of derivatives used in the portfolio, although there is not much details available on what they are. The fund webpage provides the full holdings list, that currently totals to 97 in the portfolio. These are just the bonds and do not include any derivatives positions. Browsing through the list, it can be seen that they are indeed all government bonds. Looking at the current portfolio, it seems quite strange that the fund seems to have squeezed itself into a concentrated sub-universe of mainly emerging market government bonds, which doesn't do justice to the broad universe that its investment mandate allows for. This also makes the fund having a portfolio that seems to be highly correlated to its other two sibling funds. Maybe this is the market sweet spot that the fund managers like right now. But I think having some clearer differentiations across the three funds would better help investors to decide which solutions is more suitable for different needs. For a fund incepted more than 20 years ago, the Templeton Global Total Return Fund comes with a long list of share classes for different investor types and currency choices. A refers to the standard retail share class offered in Singapore and the region. For base currency US dollars, both accumulation and monthly distributing options are available, with both launched at fund inception in 2003. For Sing dollars, there are both currency unhedged and currency hedged share classes, though both are available with monthly distributing option only. These were created a few years later in 2007 and 2009. We will take a look at the performance differences later. The A share class has a management fee of 1.05%. Adding other expenses gives a total expense ratio or TER of around 1.40%. Up to 47.5% of the management fee can be paid by Franklin Templeton to distributors as trailer fees. Distributors are also allowed to charge up to 5% subscription fee for A share class, although I think anything more than 1% for bond funds is excessive. Some distributors may offer access to the institutional I share class that has a much lower TER at around 0.85% and with no subscription fees. Investors who are interested in this fund should try to find such distributors. The distribution information of the Templeton Global Total Return Fund is available in a latest dividends PDF document found separately from the fund-specific webpage. The PDF document contains several funds, but does not cover all the share classes. Here is the distribution data for the A US dollar share class. We can see that the fund adopts a smoothened payout approach by keeping the dollar value stable and reviews it periodically. On percentage terms, the fund is paying out around 7 to 8% per annum, which is very high for a global bond fund, even if it has a bias towards high yield and emerging markets bonds exposures. Looking at the A Sing Dollar unhedged share class, we get a slightly different view. It can be seen that the distribution dollar value is being adjusted more frequently, while the yield percentage is maintained at around the same 7 to 8% per annum. So it seems that the distribution review and adjustments is trying to prioritize maintaining the yield percentage at around the same levels as the US dollar class. Data for the A Sing Dollar hedge share class is not available in the PDF, but we can find it in Morningstar. Because the currency hedging stabilizes the returns, the distribution dollar value here are more stable again with minimal adjustments. The distribution yield calculates to around the same 7 to 8% per annum, meaning that the currency hedging costs are factored into the NAV instead of the distribution payout. Let's take a look at the fund NAV versus total return chart in Morningstar. Here is a 10-year chart for the A US dollar share class, and we can see here that the fund basically has no intention to grow the NAV for the distributing class and essentially paying out as much distributions as it can afford to. The chart also shows a staggering 50% loss on the NAV in the past 10 years, with nearly no gains on total return basis. The same can be observed for the A Sing Dollar hedge share class, that has seen the NAV declining a bit more because of the additional currency hedging costs eating into the NAV. Investors who are attracted to this fund by its very high distribution payout yield should therefore take note of the NAV impacts and consider the fund from a total return perspective instead. The Templeton Global Total Return Fund provides pretty comprehensive performance data in the fund webpage. Here it shows cumulative performance across various time periods with a dynamic total return chart that allows toggling of start and end dates. The chart and data clearly show the fund has had some good times as well as bad times. The fund was particularly strong after the 2008 financial crisis until 2013, and in the past 2 years, outperforming the Bloomberg Multiverse Index. There was, however, about a decade of poor performance between 2013 and 2023, where the fund struggled and underperformed the Bloomberg Multiverse Index. This shows the fund tends to behave quite differently from the index over time, primarily due to its significant emerging market biases in both geographical and currency exposures that had led to either very good returns when the manager's views were right, and vice versa. The annualized returns data show that it can be quite painful for investors if the fund gets its views and bets wrong for an extended period, with only about 1% per annum on average for the past 15 years. Given the fund runs a top-down investment approach, its macroeconomic views can indeed persist for a long period if the managers remain convicted in their views. This is also clearly seen in the calendar year performance data, that shows the fund's returns can deviate significantly when it gets contrarian views right, such as 2025, or wrong, such as 2019 and 2020. Investors should therefore expect the fund to behave quite differently from typical global bond exposures from a performance context. The fund webpage also provides some risk measurements, where we can see the fund exhibits a much higher volatility than Bloomberg Multiverse Index, again mainly due to its significant emerging market biases. Let's see how the fund compares with its other two sibling funds under the same fund managers. In this 10-year Morningstar chart, we can see there are some correlations among the three funds. Comparing to Templeton Global Total Return, Templeton Global Bond has actually delivered the same returns for this 10-year period and comes with lower volatility and drawdown, especially in late 2022. Templeton Emerging Markets Bond, on the other hand, exhibited higher volatility and higher returns with its pure EM exposures. Templeton Global Total Return seems to be stuck in the middle in terms of positioning. And this makes me wonder if it would be better for investors to go instead with Templeton Global Bond for lower risk exposure or Templeton Emerging Markets Bond for higher returns potential. The fund has gone through a roller coaster ride for its track record. It was one of the most popular bond funds in the market from 2003 to 2013, with its exceptionally strong performance that seems to be able to persist. However, the fund struggled from 2013 to 2023 as its macroeconomic views and emerging market bets went against market movements and suffered both performance-wise and AUM outflows. Now the fund seems to be making a comeback with decent returns in the past 2 years, although with its unconventional portfolio construct and high emerging market biases, it is still quite questionable whether the fund can get its bets right this time. For investors looking for a typical developed market-focused global bond fund, this is therefore not a suitable product. There are plenty of choices available such as these ones from PIMCO, M&G, Neuberger Berman, and BlackRock that serve as a more typical core global diversified bond exposure. For investors looking for emerging markets bonds play, there are also better choices out there. For example, the iShares EM Bond UCITS ETF for hard currency play, or the Principal Finister Unconstrained EM Fixed Income Fund for active local and hard currency strategy. Again, even the Templeton Emerging Markets Bond Fund presents as a stronger performing candidate. As such, I think the positioning of the Templeton Global Total Return Fund is a key problem that Franklin Templeton needs to figure out. Lastly, let's take a look at the Sing Dollar share classes. The Sing Dollar unhedged class is a little more erratic in performance, partly because the fund uses currencies as an active play, and the currency exposures in the underlying portfolio can change significantly over time. Although performance-wise, it did hold up quite well in the past decade until 2025. The Sing Dollar hedge class, on the other hand, is impacted by the currency hedging costs to the fund's base currency US dollars, which has become quite significant in the past 2 years. As a result, the Sing Dollar unhedged class has a slightly better performance than the Sing Dollar hedged class in this 10-year chart. With that, let's summarize our findings. Franklin Templeton is one of the leading global fund providers with a long heritage. Product offerings are broad, and its branding is well known in the retail space. The Templeton Global Total Return Fund is one of the earliest global unconstrained bond strategy in the retail market, having incepted in 2003. The fund, however, has an unconventional approach that focuses on high yield and emerging market bonds, making it very different from typical global bond funds in the market. The fund adopts primarily a top-down investment approach, focusing on macroeconomic assessment that leads to portfolio adjustments in terms of country, sector, currency, and duration. There is, however, no information available on the bond selection process, which deters investors from understanding the fund better. The fund is currently highly allocated to emerging market local and hard currency government bonds, which makes it difficult to position the fund as a global bond solution and instead more appropriate as an emerging markets bond solution. However, the team also currently runs an emerging markets bond fund that overlaps this fund. Performance-wise, the fund has been unable to compare against typical global diversified bond funds or pure emerging market bond funds. While the fund has a long track record, it has shown that the fund strategy can both do well if the managers get their macro views right, such as 2003 to 2013, or do poorly if the managers persist with their contrarian views, such as 2013 to 2023. Most investors cannot tolerate a decade long of underperformance and find it hard to reconsider the fund even if it starts to do well again. In conclusion, the Templeton Global Total Return Fund is not a conventional global bond fund. The fund strategy has a long-term bias for emerging market local and hard currency bonds, and can significantly underweight developed market exposures. Given the fund runs primarily a top-down investment approach, it probably appeals only to investors who can place a high faith in the manager's macro views that have shown to do well if they get it right, as well as do poorly if they get it wrong. This concludes my absolutely biased comments on the Templeton Global Total Return Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.